All right, everybody, let's get started. Welcome. I am very glad you joined me today. Today's program is Farm Record Keeping, the Fundamental Business Management Tool. My name is Florencia Colella, and I'm a farm business management educator with Michigan State University. I cover West Central Michigan. My pronouns are she or they, and I am multiracial. So now some housekeeping. If there's anything you want to express during the webinar, including questions, you may type it in the chat box. You're also able to unmute yourself and show your video if you prefer to do it that way. And I sent something about a video release in my email. The link was wrong. I think it was Lucy who told me. So I'm going to paste the correct link in the chat. Please stay muted when you're not speaking. I may have to mute you if there's background noise. And if there are any questions that I am unable to answer live, I will send the answers in a follow-up email that you will receive after today's meeting. So I am now enabling, hold on just a second. Here. All right. So I just enabled automatic live transcription for our deaf or hard of hearing participants. This automatically adds text to the bottom of the video with a real-time automatic transcription. You can take a moment now to turn it on or off if you need it. If you're joining from a computer, you can do that by going to the CC Live Transcript button at the bottom of your Zoom window. And if you're on a phone, settings are just a bit different, but you should be able to find them by going to your Zoom options. I'd also like to acknowledge that Michigan State University occupies the ancestral, traditional, and contemporary lands of the Anishinaabe, Three Fires Confederacy of Ojibwe, Ordabwa, and Potawatomi peoples. In particular, the university resides on land ceded in the 1819 Treaty of Saginaw. But we recognize, support, and advocate for the sovereignty of Michigan's 12 federally recognized Indian nations, for historic Indigenous communities in Michigan, for Indigenous individuals and communities who live here now, and for those who were forcibly removed from their homelands. By offering this land acknowledgement, we affirm Indigenous sovereignty and will work to hold Michigan State University more accountable to the needs of American Indian and Indigenous peoples. MSU extension programs are open to everyone and we are required to ensure civil rights policy adherence to report total program participant, race, and gender data to the United States Department of Agriculture or USDA. Providing this information as a participant is voluntary, but I would really appreciate it if you could take a minute, either now during the meeting, I'm going to paste the link in the chat, or after the meeting. Well, that's not hyperlinked, but if you can copy it and paste it in your browser, there is a form that will help me show the reach of the work that I do to my bosses. Individual responses are not shared with the USDA and are kept separate from registration and mailing lists. All right, finally, I would like to recognize that as adults trying to learn while riding the demands of farming and life in general, I hope that we give each other as much grace and support as we can through our learning. So without further ado, let's get started. You are hopefully already seeing my screen, but please let me know if you are not. All right. Are you guys hearing what I'm hearing? Did you hear anything when I changed the slide? Did you hear me talk, but in a recording?
I can hear you fine. I didn't hear anything when you switched screens.
Okay, let's try it again. Hold on. Did you hear me talk about income taxes?
No.
Okay, great. Because I thought I had removed some like voice over recordings on these slides for an online course that we have. So anyway, I am actually going to take my earbuds off because otherwise I'm going to be hearing myself speak while I speak to you, and that's just not going to work. So if you have questions, either please turn on your video and wave at me or write in the chat. Okay. Thank you everybody for letting me know that you couldn't hear me, but I could hear me, and it's not fun to hear yourself. So, all right, let's go. Okay, so why is this topic important? A business with inadequate records is like a ship in the middle of the ocean that has lost its rudder and navigational aids. It does not know where it has been, where it is going, or how long it will take to get there. Records tell the manager where the business has been and whether it is now on the path of making profits and creating financial stability. Apart from providing information on a business's financial direction, records are useful for a number of other reasons. So here's a non-exhaustive mind map. Records are useful for income taxes. So prepare income tax returns, do year-end tax planning, internal assessment of financial health. So tell how you stand in terms of profit and overall financial health. Find out how you compare to the industry in a process called benchmarking. Find break-even points, like how many units of a product must be sold to cover the fixed and variable costs of production. Monitor inventories, report to partners and shareholders, split income and expenses in multiple owner businesses. Then analyze cost of production, diagnose if the inputs you're using are worth the cost, and identify and compare price trends of your inputs. And write a budget. Then make strategic management decisions. So plan. So if you want to add an enterprise or try something different, you can use records to help you evaluate that. Track financial progress over time, identify strengths and weaknesses on your farm operation, estate planning. So even if you're just starting your business, I would encourage you to start thinking about estate planning and how you're going to transition, either transfer this business onto a family member or sell it or simply get out of it. It's better to think about that upfront because how you purchase and own farm property when you're starting out has implications for what you're able to do later on. And develop business and marketing plans. Also, communication with outside partners. So obtain credit, prepare reports for partners, lenders, landlords, input providers, and government agencies. Demonstrate compliance with regulations, and establish insurance needs. And also divide landlord and tenant expenses and assist with profit sharing, distributions, and share lease arrangements. So yes, having quality financial records can help with all of those decisions. Your own farm records are the most powerful business management tool at your disposal. A quality system is one that allows you to quickly find the information you need, though, to make decisions. And that's the tricky part. So far, we have just reviewed the why, and we are going to move on to learn the goals of record keeping and how to set up a system that works for you. So let's move on to the levels of record keeping. So record keeping is the art of managing an organization's financial information throughout its life cycle, from the time of creation to its eventual disposition. The main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. In order to know how to classify your transactions, you first need to understand, that's moving on its own. So where was I? So in order to know how to classify your transactions, you first need to understand what your goal for keeping records is. We learned the many purposes and uses of records before. And so in order to achieve different goals, record keeping can be done at different levels. These levels determine the difficulty and time spent on one hand and the amount of information recorded on another. So the minimum amount of information to be collected would be what's necessary to file income taxes, and we'll call this level 1. Tax accounting organizes information according to IRS and state tax rules. Tax accounting reports usually aren't very useful for making management decisions, but they do answer questions like how much tax do I owe, which expenses are deductible, and what would the tax consequences of this or that decision be. The next level is financial. The purpose of financial accounting is to value the farm or ranch business, including all its assets and liabilities. Lenders often study this aspect when making decisions about renewing lines of credit or issuing new loans. Financial accounting information is also useful for succession planning. It answers questions such as what is my net worth and how much equity do I have in the farm. The third level is whole farm managerial accounting, which means that the goal of this level is decision-making at the whole farm level. It organizes information in a way such that it gives a complete picture of the performance of the farm as a whole. This allows producers to evaluate past decisions and analyze the potential impact of future ones. An important question that managerial accounting answers is, will I have enough cash flow to meet my needs for the next quarter? Or how much did I make last year? The highest level of accounting, or record keeping, level 4, is the enterprise level managerial type. It is accounting for decision-making at the individual unit of the farm, also known as enterprise or enterprising. This provides information organized by the different production units. So it provides very powerful information such as break-even points and profitability information for each crop, livestock species, or crop year. Depends on how you organize information. So it's very useful to set goals and identify strengths and weaknesses of the farm. So let's now take a second to discuss the concept of enterprise. An enterprise is an individual crop or type of livestock within the whole farm. Most farm and ranch record systems summarize income, expenses, and profits for the entire farm. This allows them to evaluate the performance of the business as a whole, compared to past years and compared to other farms. This is great. It's like more than what most people do. But reports broken down by enterprise are useful for determining which enterprises or which crops are contributing the most profit to the business and are therefore candidates for expansion. Or on the other hand, enterprises identified as unprofitable become candidates for elimination. However, before any farm can get to enterprise level accounting, they first need to master the previous 3 levels. So in this section, we introduced the activities of record keeping, so classifying transactions, storing evidence, and balancing and reconciling. And then we introduced the concept of levels of record keeping that will determine how you classify your transactions. So the first activity was classifying transactions, and your levels are sort of like nested within that first activity of record keeping. Finally, we defined what an enterprise is, which is part of the highest level of record keeping you could achieve, and we'll go more into detail on all of this later. So in this next section, we are going to discuss the role of personal transactions in your farm record keeping. So the main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. I'm going to hammer this throughout the presentation. So in order to classify transactions correctly, you need to understand the difference between business and personal transactions, first of all. So business transactions are those incurred by your farm business for making a profit. Family living or personal transactions are those expenses necessary for basic daily living and maintaining good health and any off-farm income sources. Some examples of personal or family living categories are wages, other business income, housing, food, clothing, healthcare, and transportation. Personal and business records must be kept separate. This is because the Internal Revenue Service, or IRS, allows you to deduct business expenses, but if you are audited and you were making business expenses, and you were making business purchases with your personal account, it can be harder to argue that you were not claiming deductions for personal expenses. The IRS may also consider that if there aren't separate records for your farm business, your farm is actually a hobby and not a business, which could have undesired tax consequences. And we'll get more into that on the next webinar. Another benefit of keeping business and personal records separate is that your accountant bill will be lower because it will take them less time to collect the information needed to prepare your tax returns. Obviously, keeping business and personal records separate is also great for understanding how your business cash flow is doing. So Some family living expenses may be deductible on income tax returns. So it is especially important to track at least those categories. Examples include medical insurance and other medical expenses, taxes paid, interest paid on personal loans, gifts given, casualty and theft losses, alimony, retirement account deductions, and expenses of students, educators, reservists, performing artists, and some government officials and members of the armed forces. So, personal record keeping can be done using the farm accounting system as long as business and personal records are not mixed, and there are ways to mark them as either business or personal. Or you can just use a completely different system. So in this link, you can find a simple personal cash flow tracker. And I'm also going to talk about the farm records book, which is a different table or spreadsheet type tool that you can use. And I think I sent a link to that in my newsletter where you all registered for this webinar. So I'll show you a few different tools, and you can either create your own or, like I said, use your same farm record keeping system for your personal expenses. So in this section, we covered personal transactions, understanding the difference with business transactions, the importance of keeping track of at least some of them, and what systems to use for this. Next, we are going to discuss the chart of accounts. So the main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. Classifying transactions involves assigning them an account or a set of accounts that help identify them. Accounts can be classified in revenue accounts that represent revenues from the different enterprises, expense accounts that represent the production and operating costs, asset accounts that represent what the business owns, liability accounts that represent what the business owes, and equity accounts that represent the investor's interest in the business. So revenue and expense accounts will comprise the income statement, and we'll talk more about the income statement later. Asset, liability, and equity accounts will make up the balance sheet or net worth statement. Examples of revenue accounts include product sales, insurance payments, custom work income, patronage dividends, and government payments. And expense accounts are custom work, rent or lease payments, supplies, sales expenses, repairs, marketing, hauling, professional services, insurance, fuel, utilities, etc. Examples of expense accounts include custom work, rent or lease payments, supplies, sales expenses, repairs, marketing. Okay, I've already said that. I'm talking about assets now. Assets are any item of value, either tangible or financial, on a farm or ranch. Examples are machinery, breeding livestock, standing crops, land, buildings, land improvements, and bank accounts. Asset accounts are usually broken down into current assets, which represent cash or items that can be converted to cash or used up in the normal operating cycle of the business, and non-current assets that represent all other assets, like machinery. Inventory accounts are also current asset accounts, but they are separately identified because of their importance. Inventory is the physical quantity and financial value of products produced for sale that have not yet been sold. Farm or ranch examples would be grain in storage or livestock ready for sale that could be sold at the time the inventory is taken. Liability accounts are any debt or other financial obligation that must be paid in the future. Examples are loans from a bank or other lending institution. Current liability accounts are those whose liquidation would require the use of existing current assets, like a credit card. Non-current liability accounts represent debts against non-current assets, such as machinery, breeding livestock, land, buildings, and land improvements. So owner's equity is the part of the business owned outright by the owners, also known as net worth. Owner equity accounts include contributed capital, this year's income or losses, and retained earnings, which represent the accumulation of your income and losses over the time the business has been in operation. Owner's equity is a good reflection of the business's solvency and ability to take risk. And we will talk more about solvency in the farm financial analysis webinar. So the chart of accounts is a list of all the accounts in the system. It should reflect the transactions that need to be tracked. The chart of accounts can be reviewed and modified, but it's important to try to get it right as possible or try to get it as right as possible from the very beginning, as recategorizing all transactions is sometimes difficult, or it could also be impossible. So when choosing account names, it may be useful to look at the IRS Schedule F, which is used to report farm income and expenses for income tax purposes. If the chart of accounts contains the same names as the Schedule F, it makes it easy to transfer amounts from the accounting system to the Schedule F at the end of the year. Finally, this is the fundamental accounting equation. It represents the relationship between assets, liabilities, and owner equity in a business. The formula can be written either as assets equals liabilities plus owner's equity, or as owner's equity or net worth being assets minus liabilities. Every accounting transaction affects at least one of the elements of this equation, but it will always balance. Revenue and expense accounts, though not explicitly listed in this equation, impact owner's equity through changes in net farm income or profit. And we will learn more about this equation when we discuss the balance sheet. So having a good chart of accounts is the key to happiness in any record-keeping system you choose. So make sure to spend some time on it. And a note on that, MSU has the Telfarm program, which is a paid service that gives you a standard chart of accounts for you to use. Using this chart of accounts makes it really easy to get a standard analysis of your business at the end of the year with the assistance of a farm business management educator like myself. So since many farms are enrolled in the program, all with the same chart of accounts, we have the ability to benchmark, which is like compare your farm's financial performance to other similar farms. So then we compare your results with average results and get an idea of whether your farm is doing good or not with respect to everyone else. The Telfarm program will also review your books and back them up throughout the year, and they can do a year-end tax plan for you. So in this section, we discussed the importance and main components of the chart of accounts, the fundamental accounting equation, and learned about the MSU Telfarm Center that provides support to farmers in the area of accounting. Next, we are going to talk about special types of accounts, because classifying transactions involves assigning them an account or a set of accounts that help identify them. Some transactions are just tricky to classify. So the accounts receivable account represents the revenue for a product that has been sold, but for which no payment has yet been received. Examples are custom work done for a neighbor who has agreed to make payments by the end of the month, for example, or grain sold on a deferred payment contract. Prepaid expense accounts are items that were purchased and paid for in one year, but not used to produce revenue until the next year. So seed is a typical example for this. Prepaid expenses and accounts receivable are asset accounts because they are things that you own or are entitled to. Another tricky account is accrued expenses. The accrued expenses account represents expenses that accrue or accumulate daily but have not yet been paid. An accrued expense has typically not been paid yet just because the due date or payment date is in the future. Examples are interest on loans and property taxes. So accrued interest is the interest that would be due, not delinquent, but due if you were to pay off the interest that has accumulated up to today. This allows for breakup of long-term liabilities into their current and long-term portions in the balance sheet. Accounts payable is an expense that has been incurred but not yet paid. Typical accounts payable are for items charged at farm supply stores where the purchaser is given 30, 60, or 90 days to pay the amount due. Accounts payable are especially important at the end of the year, where you may have items used in one year but not paid for until the next one. So accounts payable and accrued expenses are examples of liability accounts because they represent money that you owe as of a specific date. The depreciation account represents how the use of machinery, buildings, and similar assets over time causes them to grow old, wear out, and become less valuable. This loss in value or this loss in value, called depreciation, is considered a business expense over several years. It also results in a reduction of the value of the asset itself. Examples of depreciable assets on a farm or ranch are vehicles, machinery, equipment, buildings, fences, irrigation wells, and also purchased breeding livestock and dairy livestock. Land is not a depreciable asset because it has or it's assumed to have an unlimited life. However, some improvements to land such as drainage tiles can be depreciated. So depreciation is an expense account, even though no cash changes hands. One last tricky thing I wanted to mention that applies to farming in particular, as opposed to other business activities, is that certain accounts will just not appear on your accounting system. When we discussed asset and inventory accounts, we mentioned standing crops, feed and grain in storage, and livestock as some of the examples. Very few farmers will account for these things in their accounting system, but they are part of what the farm owns. And to make matters worse, one day these things may not exist, and the next day they may, or they may become worth more than they used to just because they grew. Accounting systems struggle to deal with this. So these accounts are usually best kept track of outside of the accounting system and updated less frequently, usually just once a year. So in this section, we reviewed accounts receivable and prepaid accounts, that are special types of asset accounts, accrued expenses and accounts payable that are special types of liability accounts, and depreciation that is a special type of expense account. Knowing what to do with these types of accounts is key to getting a true picture of your farm's profit. And we also talked about inventories, which are asset accounts and sometimes will just not show up in the accounting system. All right. Next, we are going to discuss a few different methods of keeping transaction information. So the main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. Classifying transactions involves not just assigning them an account, but also including some other pieces of information to help identify it. For each transaction, you will need to have the date, the amount, the vendor or payer's information when applicable, check and deposit numbers, and descriptions apart from the account itself. So how do we go about recording that? Well, we keep a journal. A journal is a record of all financial transactions, including the date, the amount, the account, the vendor or payer's information wherever applicable, check and deposit numbers, and descriptions. The general ledger is a statement that contains the different accounts for the business and the balances or totals in each one of those accounts. The totals are calculated by adding or subtracting the amounts of any transactions that have happened on that account from the journal. We usually look at the totals in the general ledger to put together other reports. So there are two main accounting records, accrual and cash. The Internal Revenue Service, or IRS, allows most farmers to use either method, but once you pick one, you are required to get their approval if you want to switch to the other. The difference between cash and accrual accounting lies in the timing of when sales and purchases are recorded. In the cash system, no transactions are recorded unless cash is spent or received, regardless of when the product was produced or the input was used. Cash accounting is simple, and it has some advantages for many farmers and ranchers when computing taxable income for income tax purposes. The one major disadvantage is that since in farming it is common to have revenue and expenses recorded in a year other than the year the product was actually produced or the input was actually used, neither the revenue nor the expenses may have direct relation to the actual production activities of the year. So any estimated profit may not truly represent profit from that year's production activities, and this can lead to poor management decisions. Then accrual accounting, on the other hand, requires significantly more entries and accounting knowledge than cash accounting, but it provides a much more accurate estimate of annual profit than does cash accounting. Under this method, you report income in the year it was earned or due, even if the payment was not collected, and you report expenses in the year they were incurred, not necessarily paid. When the products are produced and sold in the and sold. When the products are produced and sold and the cash is received all in the same year, this is no different than cash accounting. The difference occurs when the product is produced in one year and sold in the next. So for example, if a farmer produces a crop but places it all in storage for sale the following year, when prices may be higher than in the year of production, there would be no cash sales, but presumably some cash expenses. Under cash accounting, there would be a negative profit for that year. This result is a poor indication of profitability from this year's production activities, as it ignores the value of the crop in storage. Accrual accounting, on the other hand, includes an estimate of the value of the crop in storage as revenue in the year it was produced. So the result is a much better estimation of profit. Most farmers use the cash method of accounting for their day-to-day record keeping and taxes. At the end of the year, they convert the cash-based income statement to an accrual income statement to get the true picture of profit. They do this by adding or subtracting year-end inventory adjustments for those tricky accounts: grain, feed, livestock, prepays, receivables, and payables. This is called a modified system. It's neither cash nor accrual, but something in between. It's kind of like the best of both worlds. And we will discuss these adjustments more in depth in one of our future webinars. Another option when choosing your accounting system is single and double entry systems. In a single entry system, only one account is changed when recording a receipt or an expenditure. The other side of the transaction is assumed to be cash, which changes the balance in the checking account. For example, a purchase of chemicals would have the dollar amounts recorded under the chemicals column in the ledger, and that's it. A check written to pay for feed would have the amounts entered under the feed expense column. The screenshots are from the Farm Records book, which I'll tell you a little bit more about later. Recall, for both the chemicals and feed purchased, the other side of the transaction is always assumed to be cash and does not show up in the ledger. A double entry system is more complicated, as at least two accounts are impacted for every transaction, whether those are asset, liability, owner's equity, revenue, or expense accounts. In double entry systems, at least one account is credited and one account is debited. Total debits must equal the credits for each transaction. This system results in a bit more time spent keeping records, but it allows for some advantages: flexibility, as it allows records involving more than one bank account; accuracy, because accounts are kept in balance more easily or actually automatically, so there's less chance of errors, and the fundamental accounting equation is respected at all times; and financial statements can be produced at any time directly from the data already recorded in the system, because double entry systems keep track of assets, liability, and equity accounts, whereas single entry systems do not. You have to just keep track of that separately. In the table on the side, account plus is the account where money goes in, and account minus is the account where money goes out. For example, if I get a government payment, money goes into my bank account, and the offsetting account is government programs. If I spent money on maintenance items, money went out of my bank account, and the offsetting account is the repairs and maintenance one. And if I was transferring money from one bank to the other, that would make it really easy to put bank one, bank two, whereas I wouldn't be able to do that in a single entry system. So to summarize, in this section, we reviewed the different methods of recording transaction information: the journal, the general ledger, and cash and accrual systems, and single and double entry systems. So next, we are going to discuss some options for recording your journal entries. Like I said, the main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. When classifying transactions, we record information in the form of a journal. For each transaction, we record the date, the amount, the vendor or payers, information when applicable, check and deposit numbers and descriptions, and the account. There are plenty of good options to build up your records, from simple to portable to powerful. So here's a quick overview. There are paper options. For example, this is the picture of the farm records book, which you can buy from the MSU online bookstore or your local extension office. Paper systems are cheap and easy, but they make it hard to extract useful information, and it's hard to copy them or access them outside of the farm's office. There's applications you can download on your phone. Here's a few examples of free ones: Mint, Wave, and Toshul. Apps are portable, but they have a learning curve, and you are subject to their continued availability in your phone store, and you also have to have a smartphone to use them. There's also websites. So some are free, but here we have an example of a very popular paid one, QuickBooks Online. Websites are portable and you can access them from any device connected to the internet. A drawback is that they are not as powerful as softwares. And there's spreadsheets. Some spreadsheet softwares are free, like Google Sheets, and some are paid, like Microsoft Excel. Spreadsheets have a learning curve, and they are subject to user error or to some degree. They also are not able to handle large amounts of data like softwares do. So here's a few examples of free record-keeping spreadsheet templates of different kinds. The Farm Records book, which you got a link to that in the newsletter, and the Farm Cash Tracker is just a different record-keeping spreadsheet that you can check out if you would like. So finally, there are computer softwares, which are always paid. This is a picture of PC Mars, an accounting software designed specifically for farms. Softwares can just be installed in one or two computers, and you are subject to availability and price variations, but they are powerful. And then there's combinations. Most apps will usually have a website too, for example. And some of these options have the ability to export into spreadsheets as well. So if you want to personalize things a bit, you can use that. So now before we wrap this up, know that there are some really cool things out there, like some apps can store receipts and create your journal entries automatically through text recognition, for example. But your records will be great or terrible independently from the complexity or the price of the record-keeping system that you choose. It's going to be up to you and your commitment to inputting the data or verifying the data that's coming into your system on a timely basis. And any system you decide to use will have a learning curve, so make sure you save time to learn. Another thing you should consider doing is using a competent accountant and discussing your options with them also before making any decisions. So to summarize this section, we discussed some tools and options for entering journal entries, and we highlighted your role as a bookkeeper as the most important one. Finding a record-keeping system that fits your needs should be fairly straightforward once you know a bit more about each of these options, and we'll learn more about PC Mars and QuickBooks if you're thinking of those in one of our future webinars. Next, we're going to discuss a few reports that you should be able to generate from your records. So like we said before, the main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. Once you have classified your transactions, you will be able to get the information that you need from the system. A working record keeping system is one where you can easily find the information you need to make decisions when you need it. Your own farm records are the most powerful business management tool, but if you've got a chart of accounts that creates a 6-page report, then your system isn't working for you like it could. So always remember, you can go back and tweak your chart of accounts to have the system fit your needs. And there are charts of like standard charts of accounts that you could use at least to get started if you would like. To look into Telfarm or to just ask me for a standard chart of accounts, I could send one to you. So before we dig into the different reports, we need to introduce the concept of accounting period. An accounting period is a period of time, usually a year, for which reports will be produced. There are two types of accounting periods, a calendar year and a fiscal year. A calendar year goes from January 1st to December 31st. A fiscal year is any other 365-day period that does not start on January 1st. For example, a fiscal year might be June 1st to May 31st. You want to match your farm's accounting period to the production cycle of the major enterprises of the farm. Ideally, you want your accounting period to end at a time when business activities are slow. For many farms, a December 31st ending date works well, so they use a calendar year accounting period. However, other farms that have busy production or harvest times around the end of December or early January, such as winter wheat, citrus crops, or winter vegetables, may consider a fiscal year accounting period that ends after harvest. Operations that have continual production throughout the year, such as dairies or commercial feedlots, may use any convenient accounting period. For income tax purposes, many farms choose a calendar year, but sometimes I work with a farm that has two different business entities, and for one of them they have a fiscal year, for the other one they have a calendar year, so they are able to better manage their taxes. So it's also a tax management decision. So now let's discuss reports. The first one we'll see is the depreciation schedule. The depreciation schedule is a statement that summarizes the annual tax depreciation on all the depreciable assets. It's like a roadmap to an asset's tax depreciation expenses. Each asset will have its own depreciation schedule. Then all depreciable assets can be summarized into a general schedule. Some of the information you need to generate a depreciation schedule is the purchase date, purchase cost, salvage value, which is how much you'd get for it at the end of its useful life, depreciable value, which is the difference between the purchase cost and the salvage value. Useful life, the depreciation method chose useful life and the depreciation method chosen, which there's a few depreciation methods and we won't get into them now, but we'll come back to this. How much depreciation has already been taken is another piece of information that's important, and how much it's expected to be for this year. And finally, how much depreciation there is left to take. The depreciation schedule helps enter your annual depreciation journal entry and file your taxes. Next report we'll see is the balance sheet. The balance sheet summarizes what a business owns and owes. So we prepare it using the balances in the asset, liability, and owner equity accounts from the general ledger. It is based on the fundamental accounting equation of assets equal liabilities plus owner's equity. And we'll learn more about the balance sheet later. Now, for the next report, we need to define revenue, which is the value of products and services produced by a business during an accounting period, and it comes from income accounts. And let's also define expenses or expense accounts, which are costs or expenditures incurred in the production of revenue. So these two make up the net farm income, which is revenue minus expenses, and it's reflected in the income statement. To prepare an income statement, we use the balances of all income and expense accounts, including non-cash accounts like depreciation. Net farm income can also be understood as the return to owner's equity, capital, unpaid labor, and management. While not included in a report, here's a concept that you need to understand as it is related to the income statement. Profit is not the same as income. Profit is net income minus opportunity costs, or it can also be defined as revenue minus expenses minus opportunity costs. Opportunity cost is the amount an investor, you in this case, gains or misses out on when they commit one investment choice over another. And there are ways to estimate that. Reports generally only include explicit costs, but opportunity costs should be considered by managers, in particular when budgeting for a specific activity. One common opportunity cost is the value of unpaid labor and management. Finally, there is the statement of cash flows, which is a statement that summarizes all sources and uses of cash during the accounting period, and it allows comparison of actual cash flows with expected or budgeted cash flows. And it also helps inform the creation of a cash flow budget for the next accounting period. The value of a cash flow statement, as opposed to an income statement, is in its simplicity and timeliness. A cash flow statement is usually done monthly or quarterly, and it doesn't include non-cash accounting items such as depreciation. While it is not a good reflection of the profitability of the business, it is ideal for determining liquidity. and specifically how well the business is positioned to pay bills at a specific point in time. So in this section, we learned about 4 important reports: the depreciation schedule, the balance sheet, the income statement, and the cash flow statement. We also discussed the concepts of accounting period, profit, and opportunity cost. Apart from satisfying IRS requirements, keeping records will allow you to budget, communicate with funding and lending organizations, and analyze virtually anything in your farm, even production matters, and make truly confident decisions. So you can achieve this powerful goal by simply recording transactions and then summarizing them in reports. Once you've done all the work of recording transactions, make sure that you're able to pull the reports you need. Only then you'll know that you did a good job throughout. So next, we are going to discuss the process of storing evidence that supports your record-keeping entries. So we said the main activities of record keeping are classifying transactions, storing evidence, and balancing and reconciling. And in this section, we will discuss the second step. If your farm gets audited by the IRS, they will want to see, apart from your books, the receipts that support the information entered in your books, among other things. So you need to try and have an archival method in place. So there are 2 separate processes: a process to record transaction information that we just learned all about, and a process to archive receipts. Which comes first, or are these completely independent? How can you make these processes as efficient as possible? Should you just collect receipts and then transcribe that into your record-keeping system? Well, we'll discuss some of these questions next. For each transaction, we need to record the date, amount, vendor or payer's information when applicable, check and deposit numbers, descriptions, and account. Receipts may help to recall some of the transaction information, but they may not have everything you need. So you shouldn't rely on them alone to build your transaction list. Specifically, you need to know what account to assign that receipt to, which may be hard to tell or recall by the information included in the receipt. You may be thinking, well, I could just say every transaction at XYZ store is always repairs, but a specific store you buy from or buyer you sell to will not always be a certain indication of what account the transaction is associated with. The day will come when you will find you bought feed instead of repair items there, and it will get misassigned, or one transaction may need to be split among several accounts. That's why using receipts alone is not sufficient to build up your records. Sometimes you might not even get a receipt, or you may lose it, right? So if you are going to partially rely on receipts, So if you are going to partially rely on receipts to build your transaction list, you need to make sure to write account information on each receipt or put them in dedicated envelopes for each account. You'll also need a dedicated notepad to jot down any transactions that you don't have a receipt for. And you will also have to remember to print any receipts from online transactions if you happen to have those. Some people put everything on paper, receipts, notes, etc., and they move it into an archive drawer or a accordion binder by category once transactions are entered in the record-keeping system. Others use a digital receipt archival and note-taking system with a folder structure by account. Some cell phone applications that can be used to capture snaps of receipts and save them to folders are Google Photos, Google Drive, OneDrive, and Office Lens. And there are many other scanning apps. Just make sure to keep receipts separate from other photos. If you choose to use an electronic receipt storage system, you may destroy the original hard copies. Just remember to include copies of receipts from online purchases in your digital folders and make notes of anything that you don't have a receipt for. Whether you are a paper person or a digital nerd, please know the difference between an invoice and a receipt. If you keep invoices, that's great. But if you do that, either keep them totally separate from receipts or attach a receipt to each invoice once paid, as invoices do not serve as proof of payment. So in this section, we discussed different ways of storing evidence that supports your record-keeping entries and the relationship between storing evidence and bookkeeping. And next, we are going to discuss balancing and reconciling your books. The main activities of record keeping, again, are classifying transactions, storing evidence, and balancing and reconciling. In this section, we'll discuss the third step. Bank reconciliation is needed to ensure that your checking account balance is correct. Balancing is needed to verify that your records as a whole are correct. Balancing is an internal process that verifies that the fundamental accounting equation is holding in your record-keeping system. If this isn't the case, something is wrong. If you are using an Excel record-keeping system, you need to make sure it balances with each transaction you enter. Otherwise, chances are you are doing it wrong. Computerized systems, on the other hand, are designed to stay balanced. To make sure your accounts are balanced, add up your assets, subtract liabilities and equity, and you should get a zero balance. Recall, equity accounts include owners' contributions minus any draws, plus net income, and they roll over from year to year. Reconciling is a process that involves records from another party. Reconciling an account involves comparing some external source of information with your own. The purpose of doing so is to locate any differences between the two versions and to spot and correct any errors made either by them or you. The process will usually involve two lists of transactions and a way to check or cross off records that match up. How many people do you think actually reconcile? There's a large group of people that argue that we need to get with the times. This is the 21st century. Modern technology has advanced far beyond such trivial process. And sometimes that's just not the case. We still have human inputs that cause mishaps, errors happen, checks get lost in the mail, online orders disappeared, an unexpected bank fee, a wire transfer that did not get completed, checks that are outstanding and need to be addressed, etc. And these are just a few examples. So we had said that we shouldn't rely on receipts to build up records because they don't have account information or may go missing. Well, the same goes for bank statements. While they do have a lot of useful information, you should not rely solely on them as your source of information, as they may be missing information or have incorrect information. Besides, bank statements don't tell you anything about the account you have to assign a transaction to either. There are also inventories that need to be reconciled. Grain inventory reconciliation looks at what grain is in storage or what product is in storage, what was harvested and what was sold, and then makes sure that everything matches up. One of my favorite reconciliation stories comes from an extension educator who conducted a reconciliation of grain sales for a producer. Well, she found thousands of bushels of grain that were unaccounted for. The farmer was absolutely shocked and a non-believer at first, but after finally agreeing to contact the local elevator, he discovered that he was indeed sitting on a pile of grain that was racking up storage costs. So who knows how long that grain might have been there before being discovered if they wouldn't have been making a reconciliation. One common question is, how often should I conduct reconciliations? It can be done as often as daily. If you have your bank's app on the phone and you're methodical about it, or you have some sort of mobile method and you do it on a daily basis, or you can wait for the monthly bank statements and do it then. The more often, the less daunting, especially when you start racking up lots of transactions. Inventories can be reconciled once a year. But you must have any statements or records needed to be able to do it then. So make sure to keep those somewhere as the year progresses. Reconciling and balancing accounts will keep your books in check, as well as your relationships with financial institutions and other business partners. In this section, we learned why, what, when, and how to balance and reconcile. And with that, that's the end of today's presentation. I hope I did not go too fast. I just wanted to get everything in before the hour. I'm glad I made it, but I'm now going to put my earbuds on. And oh, yeah. All right. I'm starting to see a couple comments, questions. So let me first, I just copied. So far today, I gave you these two important links. I just copied one that is for a feedback form. So the one that's HTTPS, MSU, Qualtrics, etc. That's to give me feedback of today. And you won't hurt my feelings. But if you want to say good things, you can also do that. It's always great to get feedback and improve based off that. So I would appreciate it if you could take a minute. It's just one question. And the other one that you would have to copy and paste into your browser because it's not hyperlinked, that one is for your gender and race information for the USDA. So I would appreciate it if you could take a minute to click what you identify with there also. Now, to your questions. So first, Lucy, you talked about the video release form. Yes, it's a print and sign and scan type thing. So yeah, you don't actually need to sign it, but just know that that's like, yeah, no problem. Just know that that is like part of what is assumed that you are accepting if you show your video, which I would love to see your faces. I feel kind of alone, but yeah, there's implications to showing your face. And I just want to acknowledge that I understand that it's not like free for you to be here. And then, yes, Michelle, you asked if slides could be emailed to you. And yes, I can email the slides. And the other thing I was thinking is so these slides are also part of an online course that one of the ones that I was advertising in my last newsletter. And many of you did not sign up for the online course. That's kind of more involved. It's got homework and yeah, and activities, and it's great. But anyway, where I'm trying to get at is all of the videos are scripted. So we have for each slide exactly what we are saying. And for me as a learner, I appreciate being able to read as I am watching a video and as I am watching the pictures in the PowerPoint presentation. So if you think that that would help with your, with your learning or with putting together your chart of accounts or whatever you think it may be useful for, I would also be happy to send like a text document apart from the slides. All right. I am not getting any other questions. If there are none, I do hope to see you at the next one. Next time we will talk about taxes, farm taxes. And then we have some more stuff planned for a couple of weeks from now, but that's our next goal. Next Monday, farm taxes. If anyone has any questions, this is the time. You can always email them to me. You can also set up a one-on-one. Okay, I'm getting some direct messages that you would like some stuff emailed to you. So yeah, I'll definitely email you all of these resources. Yeah, so it sounds like that there are not, oh, I was saying you can set up a one-on-one meeting with me via Zoom if you want, or I could visit your farm also. I would be happy to, or call me. My number is in my email signature. So you all have that. Yeah, or text or email, whatever. All right. For now, I'll just let you all go. Thank you for your time today. And I hope to see you next Monday. Take care.